A.R.M loan is a great product. It stands for adjustable rate mortgage, and generally it's a 3-year fixed, 5-year fixed, a 7-year fixed, or a 10-year fixed. And then after that fixed duration, it will adjust every 6 months, tied to what's called the fully indexed rate, which is the margin plus the index. The margin generally is set at 2.25%, and the index is usually tied to the LIBOR index, the London Interbank Offering Rate. We didn't see as many A.R.M loans the last few years because we had what was called the inverted yield curve, which fixed rates were actually lower than short-term rates. I should say long-term rates versus short-term rates. A couple of things with A.R.M loans is there's really two components. You can do an A.R.M loan on a fully amortized loan that has a principal and interest payment. The amortization is over 360 months or 30 years. Or you can also do an A.R.M loan that's attached to an interest-only loan, which is a great product to increase cash flow. It will allow what's called recalculation of payment or automatic recast with each principal balance that's made in addition to what you owe on the loan. An interest-only loan sometimes can be harder to qualify for because it uses a tighter internal qualifying metric where you do it over sometimes 240 months versus 360, even though the payment's lower. So it can be a little confusing. Interest-only loans, when you make a payment, your balance never changes unless you apply more towards the principal balance. So the question was, why would somebody take an A.R.M loan over a fixed loan? Well, a lot of people refinance every 2, 3, 4 years. If rates drop a half point, statistically, we're in a refi market. And we've seen so much volatility this year where in a normal year, rates might go up 0.5 to 1% throughout the whole year. Now we're seeing rates drop a point in a month or increase in a month. So A.R.M loans right now are great products because these aren't forever loans. It also enables somebody to get into a higher price point where maybe they're not quite comfortable with a little bit lower rate. Someone that maybe could only buy for $1.2 million now can buy for $1.5 million because that A.R.M loan differential in payment saves them $500 or $700 a month. So you'd ask the question, why is an A.R.M loan maybe not a good fit? An A.R.M loan might not be a good fit if someone takes a 5-year loan, let's say, and maybe they're only working in their set career for another 2 or 3 years. So with that A.R.M, that's going to be adjusting to that unknown rate, even though there's caps. So A.R.M loans have caps. They have usually an initial cap, a yearly cap, and a life cap. So A.R.M loans can't go up just any amount. You can know what the caps are as you're proceeding in the process. So you want to be cautious if you are going to be losing your main income and your A.R.M loan expires because you might not be able to get a new loan.